Um, Welcome to today's deep dive. We're thrilled to have you with us as we dig into a weekly gold market outlook for March 8th, 2026.
Yeah, it's a big one today.
Right. So our mission today is to basically dissect a truly historic run. We are talking about gold's massive 100% surge over the past 12 months.
It's been unprecedented, really.
Exactly. It recently hit an all-time high of $5,589 an ounce, and right now
It's just staggering.
it really is. And right now we're trying to figure out why it is stabilizing right around the $5,172 mark.
It really is a fascinating moment for the market. I mean, seeing a drop from over $5,130 down to $5,172 can easily induce some panic.
Oh, for sure, especially if you're just glancing at the charts.
Right, but the underlying mechanics tell a completely different story.
Okay, let's unpack this for a second because dropping $400 sounds terrifying, but the consensus across the board is that this is actually a perfectly healthy correction. What we are seeing is institutional investors finally taking some of their profits off the table. But at the exact same time, retail buyers and ETFs are aggressively stepping in and buying up those dips.
And what's fascinating here is the underlying driver keeping that price floor so incredibly solid. It all comes down to central bank accumulation. We are watching a multi-year de-dollarization trend not just continue, but visibly accelerate.
De-dollarization meaning countries actively trying to rely less on the U.S. dollar for their reserves.
Exactly. And the sheer volume they are buying is staggering. The outlook projects emerging markets like Poland and Turkey.
Along with newer major buyers like Malaysia and South Korea.
Yes, them too. They are all projected to buy a massive 585 tons of gold per quarter throughout 2026. That is a lot of very heavy vaults to fill.
It absolutely is. And they aren't just buying it to collect shiny objects. They are systematically using this physical asset to hedge against massive U.S. debt and broader systemic risks in the global economy. So we have the world's central banks building this massive floor under the price of gold. But what about the traditional markets? I'm looking at these 10-year TPS yields, Treasury inflation-protected securities, and they are hovering at 1.74%.
Which is high.
Traditional economic logic says that a higher yield like that should completely crush gold prices, since gold doesn't pay you any interest. Why isn't it?
You're exactly right. Normally, when government bonds pay a solid return, investors pull their money out of gold. But the traditional playbook is out the window right now.
Because of the environment we're in.
Yes, we are in a unique inflation plus uncertainty environment. Driven by ongoing Middle East tensions and persistently high energy prices, gold is staying highly supported. Investors are treating it as an insurance policy, even when bond yields aren't falling.
And zooming in from those massive global trends down to the daily charts, the technicals are reflecting that exact same resilience. For our chart watchers out there, we're seeing a Morningstar candlestick pattern forming right around the $5,050 support level.
That's a strong indicator.
It really is. It's essentially a visual U-turn on the charts that technical analysts look for as a clear signal that buying momentum is picking back up.
Yeah.
It sets the stage to potentially retest the $5,200 mark very soon.
Exactly. The micro perfectly mirrors the macro.
So what does this all mean as we look at the outlook for the rest of March 2026? Are we going up or are we going down?
The data outlines two distinct scenarios. Right now, there is a 65% bullish probability that gold retests that $5,400 to $5,500 range.
And that upward momentum would likely be driven by those geopolitical floors we just talked about or by weak U.S. labor data, right?
Yes, like that recent unexpected drop of 92,000 jobs. A cooling job market means the Fed might lower interest rates to stimulate the economy, which historically makes gold look even more attractive.
Right.
On the other hand, there is a 35% bearish probability. If geopolitics suddenly cool off, or if a strong U.S. dollar and a hawkish Federal Reserve emerge, meaning they keep rates aggressively high to fight inflation, we could see a drop toward the $4,800 support zone.
But even with that potential downward pressure, the broader consensus remains heavily optimistic. J.P. Morgan, for instance, has set a $5,400 long-term target for gold by 2027.
Which is huge.
It is. And why does this matter to you as you look at your own portfolio? Because gold isn't just a shiny metal sitting in a vault. Right now, it is acting as a real-time thermometer for global anxiety and shifting macroeconomic power.
And this raises an important question to leave you with today. If the world's central banks are systematically trading their dollars for physical gold, what long-term vulnerabilities do they see in fiat currencies that the average investor might be completely ignoring?